How's it going, my friends? So let's talk about the most recent program that is getting a lot of buzz right now, and make sure that we're dispelling the myths, making sure that you as a consumer understand how to interpret those myths and knowing the difference. And if you're a referral partner, a realtor, or something of the sort, just to make sure that you understand it so that you can explain it to your potential buyers. The program is called the California Dream for All program. And while it has the word all in it, it is not inclusive of all. The benefits of this loan are that it can provide you upwards of 20% to be used for not only down payment, but closing costs. But in addition to that, the loan is deferred for the entire 30 years, assuming that you stayed in the home or at time of sale. So at that particular time, the question is, if you don't have a payment, there's zero interest on this loan, what are the negatives? The negative of the loan is that for you as a homeowner will have to pay back a portion of your market appreciation at time of sale. And that could be as little as 15% of the appreciated value and as much as 20% of that appreciated value. What are some of the qualifiers? The biggest and most important one is the max income qualifier. It is quite the opposite when I talk to people and I say, you have to meet the income requirement, and they say, oh, so I have to make so much money, when in fact, it's actually quite the opposite. You can't go over a certain amount. The program is designed for low to moderate income qualified borrowers. How do we determine what the income qualification is? We look at two different scenarios. One, you're gonna look at the area median income, which you can find the links below. And as far as the max goes, you should be able to reference CalHFA's worksheet, which I should be able to put something here really quick, but if not, I'll have it in the link below. You can see the max per county as far as the income to determine if you are within the threshold. You'll see some of the other pieces below, but you have to be a first-time home buyer, will have not have owned a home as your owner-occupied house for the last 3 years. If there's a scenario outside of that that is a little outside the box, hit us up and let us know and we'll help you. Credit scores are also a key element in determining the risk threshold of any loan, right? This particular loan has a 680 minimum FICO requirement. Can that change? We hope so. However, for the time being, the minimum FICO requirement for the program is 680. There are benchmarks that if you hit 700, you'll get an added benefit, but we'll dive into that further in the show notes, or just ask us for further information. The one requirement, which I feel is super important, is that you do have a home buyer education course that you have to take. But like some of the other programs, is that not only do you need an 8-hour course, you need an additional hour-long course that specifically talks about the nuances of the equity appreciation percentage that they will take and how it all works. One of the questions that comes up when considering a down payment assistance program is, Josh, what kind of product or house can I buy with this program? And in this particular case, under the CalHFA's California Dream for All program, you can finance virtually any type of property. However, there are certain stipulations around leaseholds and things like that. But let's say you're looking at a single family residence, a manufactured home, or a condo. All of those scenarios are available. And let's say townhouse, just to kind of throw it in there as a kicker. The difference is this: when we look at one's ability to get financed and give a loan, we look at multiple things. Not only the borrower's credit package and asset package, but also the property risk. Listen, friends, we super appreciate you tuning in. Hopefully you learned something today. And until next time, this is Josh with the Watershed Lending Group. Okay, my friends, so remember that there are two different scenarios for the program here, where based on your income, if it is north of 80% for the area median income, which is deemed with the links that I provided below, or if you look at the CalHFA links, you will see that you can get upwards of $202,000 in annual income, or have up to $202,000 in annual income as a household. So with that, let's dive into this a little bit. So we're going to go through this process so you can see what happens and explain this to your borrower, to your client. And if you are a client, then hopefully this will make sense. We are 1,000% happy to go over it. We love these products. However, it's really super important to understand all the nuances with them. All right, now this assumes that we're looking at a moderate income scenario, which is 80% to 100%, 150% of the area median income. All right. Now, the scenario that we're going to dive into is we got a first lien right here of $400,000, right? And then we have a deferred loan, which is the appreciation portion of that loan, the shared appreciation loan that's provided by the DREAM program. That's $100,000 day one at funding, right? Bringing it to a total of $500,000. Now, let's make the assumption that we're looking at 5 years down the road with, plus market appreciation, which I think it's roughly, in this example, they're using about 4 to 5%. I haven't done the math on it, but that's a very healthy market, and I would anticipate seeing that. So with that, let's say 5 years goes by, we're at a $640,000 value now, which, excuse me, let me back that up real quick. Anyway, you get it. We're at a $640,000 value, and that brings your market appreciation at this 640, right? Less this number right here, right? Less that, which is $140,000 market appreciation. Now, you take $140,000, the consumer is still, you as the buyer are still getting 100%. This is where it gets a little confusing, of the 80%, which is $112,000. So this dollar amount right here is all yours. So that's how much you are getting of the 140, right? And then the portion at which you have to pay back is the $28,000, this figure right here. Let's make the assumption that you are going to sell the home at this time right here. Right here, that we're selling it at this present time, which is 5 years later. The expected pay down, just based on normal principal and interest payments, would bring the loan balance to here, roughly here, at expected market rate, etc. So now you have a $370,000 loan balance at year 5, the time that you're going to sell it, right? And your original loan was this one right here, $400,000. Now let's look at the deferred loan payback. Now, how did we come up with $128,000 right here? That is the original loan right here at $100,000, right? Plus this portion right here that was calculated at the 20%. So the loan payback is $128,000, or payoff, if you will. And now the other piece is what does the equity look like if we were to have sold the property at 640 under all of these other particular parameters, right? What is the equity in the house at this time? The equity is pretty simple to figure out. Where did this $142,000 come from, right? So let's dive into that a little bit. Let's change the color just to make it easy. I'm not big on red because it draws negative connotations. So let's use yellow. All right. So if we sell at $640,000, and now we know our estimated balance is $370,000, right? And we owe $128,000. You do the math, the 640 less the total of these two right here, which is your 370 plus the 128, okay? That yields the $142,000. That's the equity portion. So, and if you look at it closely, and I illustrated here a little bit more, the $30,000 is in the equity, or excuse me, the principal paid from the original 400 less the 370, that's this $30,000. The rest of this is the homeowner's share of the market appreciation, which we deemed over here. So if the borrower's income is at or below the area median income, this is the scenario that we're going to look at here. Whoops, let me grab this. So it's slightly different than that of above 80%, in that the borrower has the opportunity to gain an extra 5% in appreciation of whatever that dollar amount is, be it $100,000 or $200,000 market appreciation. Well, hope that helps provide some clarity. If not, and it's more confusing, I get it. There's a lot to process. And don't forget that these particular slides are in the show notes below, so you should be able to click on those and reference those slides as I'm going through, so you can rationalize all the math in there, because I can tell that some of the information is blurry there. Anyway, have a great one. Feel free to sell the product, push it. We can do it. We look forward to the opportunity to work with you, and we shall talk to you soon. Take care.